Welcome to Keys Open Doors. Today, we're breaking down how national interest rates set the foundation for your borrowing costs. I am so thrilled you're joining us for this explainer because understanding the mechanics of money is literally one of the most powerful things you can do for your financial future. Whether you're actively hunting for your first home right now or you're just starting to map out your long-term plans, getting a solid grip on how debt is priced at the absolute highest levels of the economy gives you an incredible edge. Today, we're looking at a daily snapshot of national interest rates from late May 2026. We're going to decode all that dense jargon, strip away the complexities, and show you exactly how these massive, system-wide numbers actually trickle down to affect everyday aspiring homebuyers just like you.
Here's our roadmap for today. We'll start with the cost of borrowing, move to the baseline bank rate, and then explore the prime loan benchmark. After that, we'll cover long-term yields, factoring in inflation, and wrap up with your next steps.
Section 1. The cost of borrowing, your guide to benchmark rates.
All right, so to navigate your home buying journey with total confidence, you've really got to grasp the basic costs of borrowing money. Think of interest as, well, the rent you pay to use someone else's cash. Just like rent fluctuates with the local housing market, the rent for money shifts with the broader financial market. The daily snapshot we're looking at sets a foundation that absolutely impacts everyday consumers. Once you get this, you stop reacting to wild market surprises and actually start anticipating them.
Section 2. The baseline bank rate. Institutional borrowing.
Okay, so before a bank can lend you money for a house, they actually have to manage their own money, right? They often do this by borrowing from each other overnight just to meet regulatory requirements. As of our snapshot in late May 2026, the daily effective rate for these overnight institutional loans was holding super steady at 3.62%. It had been sitting exactly there for days, which is a great sign of a stable core economy.
Now, in plain English, this is the median baseline rate massive financial institutions use to transact with each other. The phrase volume-weighted median might sound a bit intimidating, but it's really just a technical way of saying we're looking at where the actual bulk of the money is moving. If one tiny bank borrows a little cash at a crazy high rate, it doesn't mess up the overall numbers. So this 3.62% is literally the heavy-duty center of gravity for institutional borrowing. It is the absolute floor of borrowing in the entire economy.
Section 3. The prime loan benchmark, the foundation for loans.
Let's step it up a level to the benchmark rate that directly influences business and consumer borrowing. This is what banks charge their absolute best, most creditworthy corporate clients. The bank prime loan rate sits noticeably higher, at 6.75%. That jump from the 3.62% baseline, that represents the profit margin, the risk adjustment, and just the general cost of doing business when lending out to the public. Simply put, this is the base rate that the top commercial banks use to price their short-term loans. It's essentially a massive consensus number. The data tracks the top 25 largest insured commercial banks in the U.S. and finds the base rate the majority of them are posting. Because of that, it's a super reliable indicator of mainstream lending conditions, since it literally reflects what the nation's biggest financial heavyweights are doing.
Tracking this number is a fantastic way for everyday buyers to gauge the general temperature of borrowing costs. Even though the prime rate is technically for short-term business loans, its influence spreads like wildfire. A lot of consumer debt, like credit cards or home equity lines of credit, are directly tied to it. So if you see the prime rate ticking upwards, you can definitely expect the cost of all types of consumer debt to follow right along. It's basically an economic weather vane for aspiring homebuyers.
Section 4. Long-term yields explained. Treasury constant maturities. Buying a home isn't just an overnight thing, right? It's usually a 30-year commitment. That means we have to look at how financial markets view long-term debt through government securities, which are basically just IOUs issued by the national government. Don't let the phrase constant maturity scare you off. It just means the market trades these IOUs for different time frames, and analysts map them out to create a yield curve. This shows us exactly what return the market demands to lock up its money for a specific amount of time.
You can clearly see the huge jump here as the timeline expands. A one-year commitment sits at 3.86%. Stretch that out to 10 years, and investors want 4.56%. Push it all the way out to 30 years, which is a standard length of a typical mortgage, and the yield jumps to 5.07%. Why? Well, time equals uncertainty. Mortgage lenders are watching these 10-year and 30-year yields like hawks when they're setting their own rates.
Section 5. Factoring in inflation. Protecting the yield. But what happens when we throw inflation into the mix? When we compare the standard or nominal 30-year rate to the inflation-protected rate, there is a massive difference.
The nominal yield is 5.07%, but the inflation-indexed yield is only 2.77%. That gap of roughly 2.3% is the inflation premium. It's the exact amount of extra return investors feel they absolutely need to offset the expected drop in the purchasing power of money over the next 3 decades.
This gap exists because those index securities are specifically designed to protect an investor's return against inflation. With these special securities, the actual principal value adjusts upwards if inflation rises. Because the investor doesn't have to stress about inflation eating away their wealth, they are totally fine accepting a much lower baseline yield, that 2.77% we just looked at. For you as a homebuyer, this is a real game changer to understand. It shows that mortgage rates aren't just arbitrary numbers. They have baked-in predictions about exactly where the cost of living is heading over the next 30 years.
Section 6. Your next steps. Empowering your journey.
We've gone from the overnight rates banks charge each other all the way up to 30-year inflation-protected yields. In general, many buyers track these benchmarks to really understand the broader market trends. But remember, these are not your personalized mortgage rates. Your actual rate is going to depend heavily on your unique financial footprint, so you must always consult a licensed professional, like a mortgage broker or a trusted loan officer, to get actionable advice that's tailored specifically for you.
Armed with a crystal-clear view of how the economy prices debt, you can approach the market with so much more confidence. Now, when you hear the news talking about rates going up or down, you aren't going to panic. You'll know it's just the foundational cost of money shifting around. You'll understand exactly why longer-term loans cost more, and you'll see how inflation expectations shape the numbers you're eventually offered. You aren't just a spectator anymore. You are a fully educated participant in your own financial future.
Keys Open Doors, helping you unlock your path to home ownership. If this helped, like, comment, and subscribe.